The Johnsons had a great summer vacation, except for one thing. Billy broke his leg when he fell off his bike. Luckily, the Johnsons have the Aflac Group Accident Plan. With the accident plan, cash was paid directly to the Johnsons for the treatment of Billy's fractured leg. Along with fractures, the plan pays benefits for certain on and off the job accidents, including treatment for burns, dislocations, surgery, physical therapy, appliances, and more. The plan also includes an accidental death and dismemberment benefit for all persons covered under the plan. Since the Johnsons have had the accident plan for over 12 months and all their premiums have been paid, they can get a $60 wellness benefit every year. They can receive this benefit when one family member has their annual physical or other preventive screenings, such as mammograms, PSAs, and blood screenings. Coverage is available for employees, spouses, and/or children under the age of 26. There are no medical questions to obtain coverage. Should you have any questions about which plan is best for you, please meet with a Mark III representative during your annual enrollment period. Meet John. John just had a heart attack. Luckily, he is enrolled in the Aflac Group Critical Illness Plan. This plan will pay him a lump sum cash benefit to help him with costs for his treatment or to use for other expenses like household bills and groceries while he is recovering. Aside from heart attack, the critical illness plan also covers illnesses such as stroke, major organ transplant, kidney failure, and more. A partial benefit is paid for heart-related treatment such as a stent implantation and pacemakers. Should John suffer another heart attack, as long as it occurs more than 12 months after his initial heart attack, Aflac will pay him the full benefit again under the plan's reoccurrence feature. If John suffers a different illness, such as a stroke, as long as it occurs more than 6 months after the heart attack, Aflac will pay him the full benefit again under the additional occurrence feature. Aflac wants to encourage John to take an active role in his health. For this, Aflac will pay him $100 per year to get a wellness test. John's coworker Steve heard about the benefits John received for his illness and wants to enroll in the plan himself. Steve has a couple of options for enrollment. He can choose a benefit amount of $10,000 without any medical questions, or up to $50,000 with underwriting approval based on a few health questions. He can choose coverage for his spouse at half the benefit he chooses for himself. $5,000 can be chosen with no medical underwriting. His children are covered at no cost at 50% of his benefit. There is a pre-existing condition clause in the plan, which means that there is a 12-month waiting period for illnesses that Steve or his dependents have been treated for 12 months prior to the effective date of coverage. Should you have any questions about which plan is best for you, please meet with a Mark III representative during your annual enrollment period. The Aflac Hospital Indemnity Plan provides cash benefits for inpatient and outpatient services for covered accidents and sicknesses. There are two options to choose from, the high option and the low option. Benefits include hospital confinement, hospital admission, a surgical benefit, an anesthesia benefit, and a wellness benefit. During the initial enrollment and for newly eligible employees, coverage is guaranteed issue. Please note, new enrollees will be subject to a 12-month pre-existing condition clause, meaning pre-existing conditions will not be covered the first 12 months of the policy. A pre-existing condition is defined as something for which you have received consultation, treatment, or medication within the 12 months prior to the effective date. Coverage is available for you and your spouse age 64 and under. Children can be covered under the age of 26. Aside from health and life insurance, disability insurance is the most important coverage to have. Why? Because it is paycheck protection. Disability coverage is designed to ensure your income should you be unable to work due to an injury or sickness. Let's take Sarah for example. The short-term disability plan offered through AUL, a One America company, pays in addition to sick leave and any other insurance such as workers' comp. So if Sarah has sick days built up, she does not have to exhaust them before her disability plan will pay. Benefits are paid directly to Sarah, and she does not have to claim it as income on her taxes since premiums are paid after taxes are taken out of her check. The plan covers her on and off the job 24 hours a day and provides income should she become disabled due to a sickness or as a result of an accident. There is a 0-7 elimination period, meaning benefits begin on the first day if Sarah were to become disabled due to an accident and on the 8th day due to a sickness. Disability due to pregnancy is covered as a sickness. This year, AUL has granted guarantee issue coverage with a few conditions. This means there is no medical underwriting to increase or obtain coverage. Let's look at these conditions. Sarah's coworker Monique is not currently enrolled in the plan. Therefore, she is only eligible to sign up for up to a $1,000 monthly benefit regardless of her benefit period. Sarah, who is currently enrolled in the plan, can increase her benefit by up to $500 per month, not to exceed the greater of 70% of her gross monthly income or $2,000. Sarah may not increase her benefit period. If Sarah wants to increase her benefit period, she will have to cancel her current coverage and elect her desired benefit period for up to a $1,000 monthly benefit. This new benefit will be subject to the pre-existing condition clause. Each following year, employees will be eligible to increase their monthly benefit by $500 without medical questions during the annual enrollment period. Please note, new enrollees like Monique will be subject to a 12-month pre-existing condition clause, meaning pre-existing conditions will not be covered the first 12 months of the policy. A pre-existing condition is defined as something for which you have received consultation, treatment, or medication within the 3 months prior to the effective date. If you currently have coverage and are increasing your benefit, like Sarah, only the amount of increase will be subject to the pre-existing condition clause. With the AUL One America Disability Plan, Sarah has the advantage of competitive composite rates. The rates on average are lower than a comparable disability plan she would find outside her employer's benefit package, and the rates are not based on her age or occupation. Sarah may not, however, obtain coverage on her dependents as the disability plan is only available to employees. In addition to the short-term disability plan, Sarah may also choose to enroll in the long-term disability plan through AUL, a One America company. Like the short-term, the long-term disability plan covers her on and off the job 24 hours a day, and benefits will not be reduced should she receive other income like Social Security or state disability benefits. With the long-term disability plan, Sarah can choose a monthly benefit up to $2,000 in increments of $500, not to exceed 60% of her monthly salary. Should she become totally disabled, Sarah's benefits would start paying after 90 days of disability and continue paying for up to 5 years if she becomes totally disabled before the age of 61. If Sarah has the short-term disability plan as well, benefits would begin immediately or after 7 days, depending if her disability was due to an accident or illness. Since both plans are offered through AUL, she would have a seamless continuation of benefits from the short-term plan to the long-term plan. Let's look at a scenario to see how her benefits would work. Sarah has a short-term disability plan with a $1,700 monthly benefit and enrolls in the long-term disability plan with a $1,500 monthly benefit. Sarah is involved in a serious accident. Her doctor says it is going to be at least a 2-year recovery period and she will not be able to work any job. Since her disability was due to an accident, benefits begin on the very first day and she will receive $1,700 each month for 3 months. After 3 months, her benefit will drop to $1,500 per month. The $1,500 per month benefit will continue through her recovery period up to a maximum of 5 years. So let's say Sarah recovers and is able to return to work after 30 months off the job. Her benefits will have totaled $45,600. What a great income protection plan. To make it better, these benefits are not taxable. Since this is the first time the long-term disability plan is being offered to you, you are eligible to enroll in the plan with no medical questions asked. However, should you choose to enroll at a later date, you will be limited to electing either the $500 or $1,000 monthly benefit. New enrollees will be subject to a 12-month pre-existing condition clause, meaning pre-existing conditions will not be covered the first 12 months of the policy. A pre-existing condition is defined as something for which you have received consultation, treatment, or medication within the 3 months prior to the effective date. However, if you are currently on the short-term disability plan with a 6 or 12-month benefit period and enroll in the long-term disability plan, you will receive credit toward the pre-existing condition clause. So if you become totally disabled due to a pre-existing condition during the first 12 months of the long-term disability coverage, you will be eligible to receive your same 6 or 12 months of benefit under the long-term disability contract, and then benefits would cease. Please note, if you choose to enroll in both the short-term and long-term disability plan, you need to elect the 3-month benefit period on the short-term disability plan, since the long-term disability benefit takes effect after 3 months. Flexible spending accounts, or FSAs, can save you money on healthcare expenses such as copays, deductibles, and prescriptions, as well as dependent child care. Sue participates in both the healthcare FSA and dependent care FSA to save on child care expenses. Let's compare Sue to Amy, who does not take part in the FSA, and see how she saves money. Both Sue and Amy have a monthly salary of $3,000. Each spends $100 per month on medical expenses and $300 per month on child care expenses. Sue uses the FSA, so she is going to set aside a total of $400 before taxes come out of her paycheck. Amy sets aside nothing. That makes Sue's taxable income $2,600 versus Amy's $3,000. Taking out 30% for taxes, Sue's take-home pay is $1,820, while Amy's take-home pay is $2,100. Now, while Amy comes out on top here, she still has to pay her monthly medical and dependent care expenses, so let's subtract $400 from Amy's pay. Sue set her money aside pre-tax, so we will not subtract anything from Sue. Now, Amy is left with $1,700, and Sue still has $1,820. You see that by using the flexible spending account, Sue is saving $120 per month. That's a total of over $1,400 for the year. Sue's FSA is administered through GilsBar. GilsBar provides her with a debit card for her healthcare FSA, and she does not have to pay out of pocket and wait for reimbursement. However, Sue does keep track of her receipts and itemized bills, just in case GilsBar asks her to verify a debit card transaction or she is ever audited by the IRS. Acceptable forms of verification will include the date of service, cost, and procedure or item purchased. Due to the availability of ineligible expenses such as toothbrushes and teeth whitening procedures, all dental expenses will need to be verified with GilsBar. The dependent care account does not have a debit card, and Sue must fill out a reimbursement claim with GilsBar. Claims may only be filed for past dates of service within the plan year. GilsBar also provides Sue with an online account at mygilsbar.com so she can view her balance, check for transactions needing verification, and access claim forms. An important point to note is the difference between funding for health care and funding for dependent care. For health care, the total annual election is available the first day of the plan year, so Sue can use all her funds up front. For dependent care, however, funds are not available for use until they have been deducted from her paycheck and deposited into her dependent care account. Remember, over-the-counter medications are no longer considered qualifying expenses unless prescribed by a doctor. Since Sue uses an over-the-counter medication for her allergies, she will need her physician to write her a prescription. Lastly, the IRS regulation Use It or Lose It. If Sue does not use all her dollars she has set aside by the end of the plan year, she must forfeit that money. So Sue only sets aside money she knows will be used for expenses incurred during the plan year for her and her dependents. At the end of the plan year, Sue has an additional 90-day runoff period to file for reimbursement on out-of-pocket expenses she has incurred within the plan year. Remember, the FSA account does not automatically continue. You must re-enroll each new plan year. For maximum contribution limits, please refer to your benefits booklet or view the flexible spending account link on the benefits website. Over 1.5 million new cases of cancer were diagnosed in the United States in 2013. This is no surprise to Jane. She has family and friends who have or have had the disease. Even though Jane has health insurance, she plans to enroll in the Humana Cancer Plan, which will give her extra income should she get cancer herself, so that she can pay for things like deductibles and coinsurance and household expenses like her mortgage, utility bills, and groceries. The cancer policy pays cash directly to Jane for the treatment of cancer or 32 specified diseases. This includes benefits for radiation and chemotherapy, hospital confinement, experimental treatment, blood and blood plasma, and much more. Let's say Jane has to travel to a hospital in another city for treatment. So Jane is not alone in her treatment. Humana will help cover the cost of one adult family member to be with her. During the annual enrollment period, Jane can apply for coverage for herself, her spouse, and her children up to the age of 25 or 26 if a full-time student. For more information, please refer to the benefits booklet, which can be found at the Policy Info tab on this website. Should you have any questions about which cancer plan is best for you, please meet with a Mark III representative. You care about your pets and consider them members of your family. So whether your family includes kids with 2 feet or kids with 4 paws, or both, you know what responsibility looks like. So why not give your pets the best health care available? The My Pet Protection Suite of pet insurance plans offered by Nationwide is composed of the only plans specifically designed for employees and gives you superior protection at an unbeatable price. Features include 90% back on vet bills, exclusivity, unavailable to the general public, one set price, regardless of the pet's age, the best deal anywhere, an average savings of 40% over similar plans from other pet insurers, and a wellness plan option that includes spay and neuter, preventive dental cleaning, and more. Plus, if you sign up multiple pets with individual plans, you can receive a discount for even more savings. Just like all other pet insurers, this plan does not cover pre-existing conditions. However, Nationwide does go above and beyond with extra features, such as emergency boarding, lost pet advertising, and more. Plus, both plans have a low $250 annual deductible and a generous $7,500 maximum annual benefit. For more information and/or to enroll in the plan, visit petsnationwide.com or call 877-738-7874 to get a fast, no-obligation quote. The Vision Plan offered by Superior Vision covers comprehensive eye exams and your choice of prescription glasses or contact lenses. Superior has a huge network of ophthalmologists, optometrists, and retail chain locations. You may get an eye exam every 12 months, and it is covered in full from an in-network provider with a $10 copay. Even if you do not need vision correction, it is important to get an annual eye exam, as eye care providers may find ocular diseases like macular degeneration, glaucoma, and cataracts, or systemic diseases like diabetes, hypertension, and high cholesterol. You may buy frames every 12 months, and you have a $150 retail frame allowance. Your standard lenses are covered in full, and you may get them every 12 months. There is a $10 copay for frames and/or lenses. There are a number of lens options, including lens upgrades. Most are available at a 20% discount. If you choose contact lenses in lieu of your glasses benefit, you cannot do both. You may get them every 12 months. Medically necessary contact lenses are covered in full after a $10 copay. Cosmetic or elective contact lenses have a $150 retail allowance and a $10 copay. Your eye care provider may require that you have a contact lens fitting exam for the proper fitting of your contacts. Standard lens fittings are covered in full after your $10 copay. A specialty contact lens fitting has a $50 retail allowance and a $10 copay. For questions on your plan, how to find a provider, how to use your benefits, or for a wealth of eye and vision information, please visit their website at superiorvision.com. Term life insurance is a great way to supplement permanent life insurance. When choosing the amount of term life insurance, think of expenses like the mortgage, credit card bills, or outstanding loans. These expenses decrease over time, so the amount of life insurance needed will decrease over time as well. Remember, the cost of term life insurance is based on age, so premiums will increase as you get older. On the other hand, permanent whole life insurance premiums lock in at a set rate and do not increase with age. Permanent whole life insurance is also more expensive than term life insurance because it builds cash value over time, where term life does not. With the term life plan offered through your employment with Lincoln County, you may enroll in up to $100,000 of term life coverage on yourself, $25,000 on your spouse, and $10,000 on each of your eligible children. You must enroll in coverage to be eligible to enroll in dependent coverage. Unmarried children are eligible for coverage up to the age of 21 or 25 if a full-time student. If you are not currently enrolled or wish to increase coverage, you must complete a short health questionnaire during the annual enrollment period to apply. Coverage will be effective upon approval. For more information, please refer to the Policy Info tab on this website. Pure Life Plus from Texas Life Insurance Company is the life insurance you keep, even when you change jobs or retire. Its high death benefit and long guarantees provide peace of mind for you and your family. And it's an ideal complement to any group term and optional term life insurance your employer might provide. With one of the highest death benefits available at the workplace, Pure Life Plus gives your loved ones peace of mind, knowing there will be significant life insurance in force should you die prematurely. Designed to provide a high death benefit at a reasonable premium, Pure Life Plus provides peace of mind for you and your beneficiaries while freeing investment dollars to be directed towards such tax-favored retirement plans as 403Bs, 457s, and 401Ks. Enjoy the assurance of a policy that has a guaranteed death benefit to age 121 and level premium that guarantees coverage for a significant period of time. Unique in the marketplace, Pure Life Plus offers you a refund of 10 years premium should you surrender the policy if the premium you pay when you buy the policy ever increases. Should you be diagnosed as terminally ill with the expectation of death within 12 months, you will have the option to receive 92% of the death benefit minus a state administrative fee. This valuable living benefit gives you peace of mind knowing that, should you need it, you can take the large majority of your death benefit while still alive. Coverage is guaranteed as long as required premiums are paid, even after you retire or terminate employment. Coverage is portable. Once issued, continued employment is not a condition to continue coverage. Coverage is available to employees and their spouses, domestic partners, children, even grandchildren are eligible to apply for coverage. Buying life insurance is a personal decision, and as such, you will have the opportunity to consult with a Mark III representative. Should you decide to apply for coverage, the enrollment representative will guide you through the application process. Our contingent guaranteed issue allows you to apply for generous amounts of coverage by answering just 3 work and health-related express issue questions. Let's talk about life insurance. What is it, and why do we need it? Meet Greg. Greg already has term life insurance, which he purchased to cover short-term expenses like the mortgage or credit card bills. But what about a long-term solution that will last beyond his employment and into retirement? For Greg, the Texas Life Solutions 121 plan is the answer. The Solutions 121 plan is a whole life policy that provides a guaranteed death benefit, guaranteed level premiums, guaranteed paid up life insurance benefit, guaranteed cash value accumulation, and an accelerated death benefit. What do all of these guarantees mean? A guaranteed death benefit means that Greg's benefit will not decrease or cancel due to age or illness. Level premiums mean that once Greg enrolls in the policy, his premium is locked in based on his age as of the effective date and will never increase. The policy is guaranteed paid up at age 65 or after 20 years if he purchases coverage at age 45 or older. With cash value accumulation, Greg can use the cash value as collateral for policy loans if he has an emergency or as a cash benefit should he choose to discontinue coverage. For no additional premium, the policy includes an accelerated death benefit due to terminal illness rider. Should you be diagnosed as terminally ill, with the exception of death, within 12 months, you will have the option to receive 92.6% of the face amount, minus an administrative fee, in lieu of the insurance proceeds otherwise payable at death. This means that you will be able, should you need it, to take the large majority of your death benefit while still alive. And finally, the Solutions 121 plan is portable. If Greg terminates his employment or retires, he can continue his coverage as long as he continues paying his premiums. While the premiums will remain the same, you will need to set up direct payment with Texas Life. Greg can apply to get coverage for himself, his spouse, children, and grandchildren. It's easy to enroll. To qualify for coverage, Greg only needs to answer 4 questions. Since the plan is offered through his employer, he will find that the rates are generally lower than a similar plan that he would find on his own. For more information or to find a plan that is best for you, meet with a Mark III representative during your annual enrollment period.
As a voluntary benefit, full-time county employees can contribute to a 401k plan through Prudential Retirement. We will cover why you need to save more for your retirement, understanding the features of 401k, and how to get started. Your local retirement education counselor, Kristen Bryan, will be available to help you through every phase, starting at enrollment and all the way through retirement. She will also be at your mandatory benefits meeting on Wednesday. How do you, as an employee, envision your retirement? We understand that different individuals have different desires in mind, but most of them have one thing in common. They require money to make them happen. Will you have money to cover your must-have expenses, such as health care, housing, food, and transportation? And where will your retirement income come from to cover these expenses and more? Will your money come from the North Carolina retirement system, post-retirement earnings, savings, or other resources? There are many reasons you need to save a little extra for your retirement. First, let's talk about one of the biggest misconceptions people have about retirement, that it is simply a function of age. That is just not true. Retirement is about much more than just reaching a certain age so you can stop working. The reality is that retirement is a matter of having enough money to support your standard of living after you stop working, regardless of how old you are. You can retire when you can afford to stop working. For some, that may be at 65. For others, maybe 62 or 57. For a lucky few who begin planning early enough, maybe 50. Now think about this question. How much money do you think you'll need to support your lifestyle if you live to be 80, 90, or 100 years old? Many financial professionals explain it this way. In order to maintain your current standard of living during retirement, you will likely need an annual retirement income of at least 80% of your final working income. So the point is that no matter how you view it, we're all likely going to need a lot of money to create a more secure retirement. You need to make sure that you're taking inflation into account as you save. For example, let's look at the cost of a loaf of bread just a few years ago in 2012 when it was an average of $1.50. But take a look at what the rate of inflation could do to the amount you'll spend on bread in the years to come. In the year 2020, that same loaf of bread could cost you $1.98. In 2030, $2.79. And in 2040, that same loaf could cost you $3.94. This illustrates the importance of how you're investing your retirement savings. If you're not investing your money in a way that at least keeps up with inflation, you'll actually be losing buying power in the years to come. How much control do you have over the increased cost of inflation? What can you control? How can you zap back at inflation? What power do you have today? What is within your control today that can help you prepare for tomorrow's increased cost of living? For North Carolina public employees or educators, the first piece of retirement income pie is the pension plan. You'll hear this referred to as the North Carolina Retirement Systems, or ledgers for short. Most of you are required to contribute 6% of every paycheck to your individual account at the retirement system. Once you've been employed in North Carolina state or local government service for at least 5 years, you are vested. Vested means that you are eligible to retire at some future date and begin receiving a monthly benefit for the rest of your life. You can begin receiving retirement benefits when your years of service and age meet the minimum requirements as shown in this table. Many employees are surprised to learn that their monthly pension benefit has nothing to do with what was contributed over the years. The amount of your benefit is based on a formula that is also described in the local government employees retirement system handout. It takes into account the average of your 4 highest consecutive years of salary, your years and months of service, and a retirement factor that is set by the General Assembly. For comparison purposes, this table reflects the averages from 2017. Another page in the handout describes the various payout options available to you at retirement. According to the Treasurer's Office, all options are actuarially equal. That is, no one option is better than the others financially on paper. However, when you factor in your own circumstances, you may find that one particular payout option would likely be most advantageous for you. Please do not base your choice of payout on what your coworker may have chosen. Your life conditions may be very different and therefore dictate a different option when you choose to retire. As you are thinking about what your benefit might look like, remember that cost of living adjustments or COLAs are not guaranteed. All of this means that inflation can erode the value of your pension benefit over time. I would like to take a moment to introduce the 5 key actions you can take to make the most of your retirement plan during your working years. Doing these can help you get on track to meet your retirement goals. First, you start by enrolling. Then allocate, consolidate, increase, and catch up. I can help you take any one or more of these actions when you come to your mandatory benefits meeting. Some benefits of enrolling include decreasing today's taxable income, generating future tax-deferred potential growth. It is easy to get started. Plans are flexible and have low cost savings. Those differentiators center around who is eligible to participate, when withdrawals may be made if they're still working, and whether the withdrawal could be subject to an IRS early withdrawal penalty. One of the other major benefits to investing in an employer-sponsored retirement plan is that your contributions are tax deferred. This means that each dollar you save is one less dollar that your employer reports to the IRS as income. This lowers your current federal tax liability and, as a result, does not impact your pay as much as you might think. Let's take a look at an example. Here's how Nick's paycheck looks before he starts saving in the plan. What happens to his paycheck after he starts saving 3% of his pay? His take-home pay is only $63 less than before he started saving. That's the power of tax-deferred investing. Let's look at Rita's situation. As a working mom, Rita's juggling a lot of financial priorities. She feels like she can't afford to have any more money come out of her paycheck. However, when you look at it closely, you can see how little an impact it will make in Rita's weekly take-home pay while giving her tax savings and potentially making a significant difference in how much she could have at retirement. Take a look at some examples of how much certain contribution levels actually affect a retirement investor's paycheck. A different type of contribution would be a Roth plan. These contributions are made after tax and offer future tax-free income. Employer contributions for law enforcement officers are made to your account on a pre-tax basis only. When considering a Roth plan, think about whether or not you want a tax break now or later. Now is the best time to start saving. In this next example, Sarah just started working for her employer, but thinks she has plenty of time until retirement, so she hasn't thought about starting to save for it now. Let's assume she puts off starting to save until age 30. She saves $100 a month, and she continues saving at that rate, and her account earns 7% per year. If she started 5 years earlier, though, look at the difference it would make over time. Let's look at Tom's situation. He's feeling discouraged when he thinks about how little he has saved for retirement throughout his working years. The good news is, it's never too late to save. In fact, even a little can make a big difference. Imagine Tom saves just $25, $50, or even $100 each month. Look at how much he could accumulate within 20 years. Just think, if you were planning on retiring in 20 years, how much more secure you would feel if you had $142,000 or even $155,000 in retirement savings when you stopped working. Keep in mind also, even if you didn't save as much as you would have liked when you were younger, you can still make up for it by contributing as much as you can now. And if you are age 50 or better, you qualify for catch-up contributions, which means you can contribute an extra $6,000 over the annual contribution limit for this year. While it is good to start as early as possible, it is never too late to save more towards your retirement. All too often, we sit down with plan members to review their account and discover that they've never increased their contribution rate. They are still contributing the same amount as the day they started their plan. While it's great that at least they're saving, they've missed a key strategy to building retirement plan value: the power of increasing contributions over the years. Here's an example of two hypothetical plan members, James and Julie. They both get started saving $100 monthly in one of the North Carolina plans. These two members are invested exactly the same, earning an annual average rate of return of 7%. The only difference is that each year, Julie adds $10 to her monthly contribution rate. So year one, Julie contributed $100 a month, but year two, she increased her contribution to $110 a month. Year 3, she increased her contribution to $120 a month, and so on. The difference in their account value is staggering. After 30 years, Julie has almost twice as much in her retirement account as James does. People often think that adding just a few more dollars to their contribution rate won't make a big difference, but we are here to tell you that it does. When choosing your North Carolina 401k plan investments, you have two options. You can do it yourself, or you can get help with GoalMaker. An important investment concept called asset allocation can help you choose your investments and minimize risk. So what is asset allocation? Asset allocation is simply the process of spreading your money across different types of asset classes, stock, fixed income, and stable value investments. By dividing your portfolio among a variety of investment classes, you minimize your reliance on any one investment and help manage your investment risk. Historically, the markets move in cycles. Generally, when one kind of investment is performing well, another may not be performing as well. Changing economic and financial market conditions affect asset classes differently. And since you don't know which asset class will perform well next year or the year after, having a variety of asset classes in your portfolio may help you to better weather the rough spots in the market. For each investment, there is a risk-reward relationship. If an investment offers little risk of losing money, it may also offer less of a chance for the reward of earning money. An investment with greater risk may offer a higher chance for reward. This chart explains what I mean. On the left are low-risk investments, such as stable value funds. Because these offer little exposure to the markets, you may be protected from the ups and downs of the market. But in exchange for the stability of smaller, steadier returns, you potentially sacrifice the chance for bigger returns. As we progress to the right, the investments increase in degree of risk, which also potentially increases the chance of return, or the ability to earn money. At the far right, we have the investments that offer the most market risk. But remember that the potential risk has increased, so you also have a greater chance to lose money. That is the idea behind risk versus reward. And it's important to understand when choosing your retirement investments because every investment has some degree of risk. GoalMaker can help make investing easier. GoalMaker uses two simple pieces of information: your expected retirement age and your investor style, conservative, moderate, or aggressive, to guide you to a suggested model investment portfolio made up of the investments available in your plan. However, you may always choose whichever GoalMaker portfolio you like. Once you have chosen your GoalMaker portfolio, GoalMaker will automatically rebalance your investment mix and shift it over time as you near retirement and even after retirement. If you leave your job, it's important to know that you have a number of options for withdrawing your funds. You can leave your assets in the plan until age 70 and a half, when you must begin making minimum withdrawals. You can roll these assets into an individual retirement account. If you go to a new employer, you can roll these assets into the new plan if your new employer accepts rollovers. You elect a systematic payment option. For example, you may choose to have your assets dispersed monthly, quarterly, semi-annually, or in an annual installment. You can have the money sent to you in a lump sum or simply take it out on an as-needed basis. You can transfer all or portion to an annuity and receive guaranteed stream of income for life. Should you need to access your funds while still working, you can take out loans against your 401k. So now it's time to put all of what you learned today to work for you. You will need to decide how much to contribute, choose your investments, enroll in the plan, elect a beneficiary, and consolidate prior retirement plans. Your local retirement counselor and other resources are available to help you through every phase, from enrollment through retirement. The Retirement Income Calculator helps you determine how much income you'll need in retirement, which can help you learn whether or not you're on the right path to a comfortable retirement. If there's a gap in between where you're headed and where you'd like to end up, it will recommend ways to make up the difference. The calculator retains your data and syncs with your online retirement account, automatically updating every time you log into your account. It also lets you test drive new saving scenarios, such as a higher contribution level, at any time without having to re-enter your information. It's a great tool that can help your retirement planning stay on track. The My North Carolina Retirement Statement, or MRS, which the North Carolina Department of State Treasurer provides each year to active employees with at least 1 year of service, gives you a snapshot of your projected total retirement benefits. The MRS was formerly known as the Annual Benefit Statement, or ABS. Your MRS is published each spring, and it's available to you throughout Orbit. Lincoln County's Prudential representative is Kristen Bryan. She will be available to speak with you at your benefits meeting on Wednesday. Should you have any additional questions, she can be reached by phone at 704-219-7290 or via email at kristen.bryan@prudential.com. Enrolling in the North Carolina 401k plan is easy. You will complete an enrollment form at your mandatory benefits meeting. Contributions will take effect with the next available payroll. Your account offers you some terrific, easy-to-use tools that are designed to help you. Each quarter, Prudential Retirement will provide you with an easy-to-read retirement statement that includes all the information about your account, including fund performance, your account value, tips on how you can save more, important updates from your employer, and more. You may elect to access your statement online for added convenience and security rather than receive it in the mail. You can also take advantage of our toll-free phone service by calling 866-NC-PLANS, where you can obtain account information or perform transactions through your telephone keypad. Prudential's participant website, ncplans.prudential.com, with its easy-to-navigate tabs, makes it a breeze to find the information you need and to process your transactions online. Simply visit northcarolinaplans.prudential.com to quickly view your account details, transfer money between investment options, increase your contribution amounts, change investment options, check fund performance, and review, print, or request online statements. Thank you so much for viewing this presentation today. I encourage you to take what you've learned here, along with the tools that Prudential provides, and get started on your retirement. Be sure to act today to protect your tomorrow. Once again, Kristen Bryan will be at your mandatory benefits meeting on Wednesday to complete your enrollment and to answer any questions.
Nationwide presents What is a 457B and why should you enroll? If you're an employee in the public sector, you may have heard the term 457B tossed around, but what exactly is it and how does it work? A governmental 457B plan, also referred to as a deferred comp plan, is a powerful financial vehicle that can provide you with the ability to save for the retirement you want. And it's a benefit available exclusively to public sector employees like you. A 457B is an employer-sponsored, tax-advantaged plan that uses the power of compounding, where your earnings are reinvested over time. For the most part, it operates like a 401k. It's a long-term deferred comp plan that's designed primarily to provide extra retirement income for you, because pension and Social Security may not be enough. The key difference? A 457B plan has no 10% penalty for withdrawal of funds before the age of 59 and a half. Here's how a 457B plan works. You select the amount you want to contribute per pay period. Next, decide how to invest your savings. You can either elect a traditional tax-deferred contribution, or, if available, you can elect a Roth plan, which invests your savings after tax. Finally, you'll designate how your contributions and any earnings are to be invested via allocation options that are available through your employer's specific plan. Throughout your enrollment in the plan, you have the ability to monitor and manage your investment, track your progress, and make changes to improve your retirement readiness. Then, when you're ready to retire, you decide when and how to withdraw your funds. Plus, you'll also have access to personal service from retirement specialists who are dedicated to helping you work toward your retirement income goals. To enroll in your 457B plan, call 1-855-463-4977 or meet in person with a nationwide retirement specialist. You can also stop by your HR benefits office for an enrollment kit. Or if your plan allows, you can enroll online at nrsforyou.com. As a public sector employee, you work hard. It's time to start saving for your retirement with a deferred comp plan that will work just as hard for you.
Ever wonder how a retirement plan works? A retirement plan is considered a benefit. Not all employers choose to offer one, making it a key advantage workers look for when considering job opportunities. That's because today, people are living longer and employer-provided pensions are becoming a thing of the past. Even those with a pension, when coupled with Social Security benefits, can struggle to meet their basic retirement needs and pay for rising healthcare costs. That's why various types of retirement plans were created by the federal government to help you save for the future. First, the government established a few overall rules about how retirement plans work. In most cases, these plans are sponsored by an employer, who then defines additional details when offering this benefit to employees. The plan sponsor selects a provider, like Nationwide, to administer and/or record keep the retirement plan for their employees. The provider is tasked with enforcing the government's rules, as well as your employer's rules, and may also provide educational workshops, people to help you plan, quarterly statements, and more. And with a strong foundation and heritage you can trust, Nationwide's approach helps participants optimize their retirement outcomes. The market also plays a role in saving for retirement. The markets fluctuate daily, and so will your account balance. However, you're saving for retirement, and investment markets have historically gained money over the longer periods of time, making it an appropriate vehicle to help you potentially grow your money through long-term investing. As an employee, you decide if you want to enroll in a retirement plan and save for your future. If you choose to enroll, you become a participant and have several powerful levers at your disposal to improve your retirement readiness. You control how much you contribute, where to invest money within the options provided, whether to change investments at any time, who to list as beneficiaries. You can even take advantage of learning sessions, budgeting tools, and more. Plus, you can keep your money in the plan well into retirement and withdraw money as you need it. There are tax benefits to having a plan as well. Let's say you earn an annual salary of $50,000, but contribute $10,000 to your tax advantage retirement plan. For that tax year, the government will only tax you as if you had a $40,000 salary, thus saving you money. But remember, saving for retirement is a long-term goal. So for instance, if you withdraw your money earlier than the rule allows, the government may charge you a 10% tax penalty. A retirement plan is a valuable benefit, and as with anything in life, there are some fees that go along with it. Your plan sponsor negotiates the most favorable terms possible with the provider, and a portion of these fees may be passed on to you as a participant of the plan. In most cases, these fees are lower than those you may pay if you were to invest outside of a retirement plan. Now you know how a retirement plan works, and at Nationwide, helping you reach and maintain your goals is what we do best.
Today, only 22% of people feel that they are truly prepared for retirement. That's why Nationwide provides tools to help employees know where they stand with their retirement goals so they can prepare for the retirement they want. Nationwide offers one place for a holistic experience that is simple and easy for employees to navigate. One way we help bring this together is with our Retirement Readiness Report, which helps answer the common question, "How am I doing?" and helps employees understand what to do next to help achieve their retirement goals. The Retirement Readiness Report is part of our online experience that delivers an award-winning, mobile-responsive website, allowing employees using any device to access tools and educational content. It provides them with the information they need and the ability to take action within their account. Once logged in, employees can generate the Retirement Readiness Report by entering only 4 pieces of information. The Account Overview page presents employees with a tailored snapshot of their account balance, projected retirement income, and retirement readiness status, which helps immediately gauge how close employees are to reaching their goals. My Interactive Retirement Planner provides the ability to further personalize the Retirement Readiness Report by entering additional account information. The end result is a robust and holistic retirement readiness report that employees can act on. Our comprehensive retirement readiness experience is designed to improve financial well-being by helping employees take steps to reach their retirement goals. This is just another way that Nationwide is on your side. For more information, contact your Nationwide representative today.
Nationwide presents How Can You Invest in Your Plan? As a public sector employee, you are eligible to save for your retirement with a 457B deferred comp plan. A 457B from Nationwide is a great way to take control of your retirement savings because with it, you designate how your contributions and any earnings are to be invested. You also have the ability to monitor and manage your investments through the plan. Either way, Nationwide may offer a solution that works for you. In order to help you feel confident in your investment choices, start by identifying your personal investment style. Ask yourself, when it comes to investing, what makes you comfortable? Do you like to manage every detail? Would you rather have experts do the heavy lifting? Or are you somewhere in the middle? The only right answer here is what works best for you. To help you define your investment style, here are 3 options to consider. 1 option, the investment do-it-yourselfer. You have the ability to personally define your retirement goals and make the appropriate investment allocations that best meet those goals. You can then monitor, rebalance, and adjust your allocations as your goals and investing needs change over time. A second option may be an investment that can rebalance your portfolio or invest your savings based on your investment style and tolerance for risk. These can be helpful in simplifying your investment strategy. However, if all this seems overwhelming, you may be able to go with the do-it-for-me option. If your plan has a managed account solution, you may be able to have a qualified financial professional manage your investments and make the investment decisions for you for a small asset fee. If you're interested, ask if your plan has a managed account option. The bottom line? No matter what your personal investing style, your 457B plan may have options that fit you. If you have any questions or to learn more about your options, contact a Nationwide retirement specialist at 1-855-463-4977 today. Nationwide presents How Much is Enough? A secret strategy for retirement saving. These days, the word retirement doesn't exactly mean what it used to. As a society, we're living longer and doing more. The definition of retirement today is as unique as the person who is saving for it. So here's a question. How much will you need for your version of retirement? While that's a question only you can answer, here are 3 practical steps you can take to help you calculate and save for the retirement you want. Step 1, start with your goal. Ask yourself, how will you define retirement? Where will you live? Travel, hobbies, put it all into the mix and write it down. Your retirement plans will probably change over time, so make sure you're keeping your definition current with your evolving expectations. Now, with your retirement goal in place, we come to step 2. Ask yourself, how much do you need to save now to enjoy later? It is crucial to realistically count the cost of your retirement plans and determine what it will take to get there. A helpful resource is My Interactive Retirement Planner, a comprehensive online planning tool from Nationwide that gives you an overview of your retirement planning progress in less than 10 minutes. And you can make changes to improve your retirement readiness right from the tool. Which brings us to step 3, the not-so-secret strategy of step-up savings. While fixed contributions are good, a strategy of methodically increasing your contributions as you go can make a huge impact on the kind of retirement you can afford. For example, if an investor started saving $100 per paycheck at the age of 30 and maintained that pace at 65, not bad. But if they increase their deferral by just $25 per paycheck every year, well, see, a little can go a long way. To make it easy, try automating your savings step-up. If your plan offers an auto increase feature, consider signing up. And if you're age 50 or older, or within 3 years of retirement, contact us about special opportunities to save a lot more before you retire. The bottom line, you can have the retirement you want. Consider increasing your retirement contributions today. It could pay huge dividends for you tomorrow. To step up your saving, log into your account at nrsforyou.com. And if you have any questions, talk with a Nationwide retirement specialist at 1-855-463-4977. Nationwide presents Managing Multiple Accounts. If you're like most people, in your lifetime, you will change jobs an average of 11 times. With that many career moves, it's easy to accumulate various retirement savings accounts, a 401k here, a 403b there, and maybe an IRA or two somewhere else. At some point, managing all the accounts, reviewing all the reports, and staying on top of your investments can get to be a bit much. For instance, it can be difficult to keep all your investment selections aligned with your overall goals. You may have outdated allocations that carry more risk or are delivering less growth than you need to meet those goals. What's more, each retirement account carries its own set of fees, so you're likely paying more than you need to. And if you ever need help or advice, most representatives cannot provide guidance for investments or strategies that are not in their plan. So you're left having to figure it out on your own. At Nationwide, we make it easy. A great solution to maintaining multiple retirement accounts is to consolidate your assets into one unified account. In doing so, you'll simplify all the redundant fees, paperwork, and contacts, which makes it easier to manage your investments and maintain your strategy for retirement income. If consolidating your retirement assets into one account sounds appealing, Nationwide makes it easy. Nationwide retirement specialists can show you the broad portfolio of options available within your plan. And because you're a public sector employee, we have competitive fees, which means more of your savings goes to providing income for your retirement. Nationwide has over 40 years of experience in serving public sector employees' retirement needs, with the resources to help you set and reach your retirement income goals. If you have questions about rolling your assets into a Nationwide deferred comp plan, or are ready to start the process, call us at 1-855-463-4977 and talk to a Nationwide retirement specialist today. You should consider all factors before making a decision to move any retirement assets. Moving retirement assets from one plan to another may have unintended surrender, fee, or tax consequences.
Congratulations on your new job. Since you're now a local government employee, you're eligible to join Local Government Federal Credit Union, or LGFCU. LGFCU is a credit union. Simply put, it's a better way to bank. When you become a member of LGFCU, you're joining nearly 300,000 other local government employees across North Carolina. Members of LGFCU are the credit union's owners. Each member has a vote. And instead of answering to shareholders and investors like a bank, a credit union is member-focused. Any profits made by the credit union are passed back to members through lower rates, higher dividends on deposits, and expanded financial products and services. LGFCU has been helping members achieve their financial goals since 1983. For that reason, LGFCU has contracted with State Employees Credit Union, or SECU, to deliver branch and ATM services to its members. While LGFCU and SECU are two separate credit unions, our partnership allows LGFCU members to enjoy full service at SECU's more than 250 branches and nearly 1,100 Cash Points ATMs across the state. Or you can access your accounts with online banking anytime or anywhere. It's that easy. LGFCU offers members checking accounts, share accounts, commonly known as savings, competitive loan rates, fewer fees, great dividends on deposits, and much more. Plus, you'll have access to many other products and services designed to make your life easier and help you achieve your financial goals. If you're ready to join LGFCU, just take a pay statement or employee badge to a nearby branch. To find your closest branch, go to lgfcu.org/locations. If you have questions, call us anytime at 888-732-8562. LGFCU, we're a better way to bank.
LGFCU is an equal housing opportunity lender and federally insured by NCUA.